Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Grant Bledsoe. How you doing today, Grant?
I'm doing really well. Thanks for having me on the show today.
Good. Well, glad to have you here. You were nice enough to invite me on your show, so I figured it's it's only right that I invite you on mine, even though it was well past what was probably etiquette would apply. But anyway, Grant, tell us a little bit about your background.
I am a financial planner, financial advisor, not too much unlike yourself. My firm is Three Oaks Wealth. We work with owners of smaller privately held businesses, typically fewer than 15 to 20 employees, and we help people optimize their cash flow and income, pay a little bit less in tax, and invest prudently for their long-term benefit. So we've been in business for about 10 years. Prior to that, I had a Wall Street trading job at Charles Schwab on their securities lending desk, which is a really cool place to kind of cut your teeth and learn about the industry. But ultimately, like you, I wanted to help people a little bit more directly and really truly enjoy what we do on a day-to-day basis now. So it's been a good ride, and I don't plan to do anything different here for quite some time.
Nice, nice. Well, one of the things that really wanted to bring in the show is, we bring on some financial advisors if there's some reason to, because there's so many out there. But you're also a CFA, right? And a CFP?
I am, yes.
Okay. So yeah, so we had a really interesting conversation on your show, and I highly suggest the listeners listen to it. It was a lot about inflation and the markets. So I just wanted to kind of dip in because really this has been a very interesting market, interesting inflation environment. Everything's been interesting. I can come up with a lot of words, but right now that's the one I'm going to use. So Grant, why don't you give us kind of like your quick opinion of what you think of the markets? Just give us kind of your high level and we can go from there.
Yeah, that works. That works. This is, it has been a little while since you came on my show, but this is very reminiscent because the tables were turned. It's the exact opposite dialogue of where we started when I interviewed you, and it was a great episode. I appreciate you coming on. Here's my take on the markets today. We had this sustained period of ultra low interest rates after the mortgage crisis. And then we were thrust into COVID and we had a whole bunch of money printing. I think the total was around 6 trillion in fiscal stimulus coming from the government. And that led to inflation, somewhat unsurprisingly. And now, in maybe the 18 months since, we've gone from a near zero interest rate policy way up to where we're at today. And so that's put a lot of pressure on a number of different industries. We have smaller regional banks. We had Silicon Valley Bank run into all sorts of trouble earlier in the year. Just recently, a couple of weeks ago, we've had other smaller regional banks downgraded by Moody's and S&P. And I think we have two or three other shoes to drop here as a result of this steep increase in short-term rates. And the stuff that hasn't really seen much impact yet, but will. Number one, commercial real estate. A lot of people are really freaked out about that. As you probably know, and as your listeners know, when you buy a big commercial building, usually those mortgages are amortized over 25 years and the interest rate resets about every five. And we're, what, 18 months into when the Fed started hiking? Does that sound right, Kirk? So we're just at the beginning of this period before many of these commercial loans have had to reset. And when they do reset, now all of a sudden, in order to pass through those costs, the owners are going to have to increase rents or just do something different. So the values of the commercial real estate holdings that we're seeing around the country are going down. On top of the fact that fewer people are going into an office every day to work, there's less demand for all that commercial real estate. So that's one. Another one is for consumers. I saw a stat recently that in the last 2 years, debt service, if you take out mortgages, credit cards, and auto payments, as a percentage of personal income, debt service has gone up from 1.2% of personal income to 2.2% in the last 2 years. Doesn't seem like a whole lot, 2.2% of personal income. That's almost a 100% increase. So consumers are carrying more credit card debt. They have larger auto loans. Auto payments are up because interest rates are up. And it's really hurting the consumer. And so yes, that can continue for a little while, but it can't continue forever. And on top of that, so I mentioned the two, right? Commercial real estate, consumer. There are a bunch of others that I'm sure you can rattle off, Kirk. But the third one that's interesting to me is the way that our federal government debt is financed. We run big deficits every year, so our federal government has to borrow a whole lot of money to finance its operations. And I believe that about 2/3 of all the federal government debt is going to need to be refinanced in the next 5 years. So interest rates have gone up, right? We haven't had to refinance a whole bunch of that debt yet, but when it comes due, now all of a sudden it's going to be much more expensive for the federal government to service. And seems like people are not caring too much about the deficits that we're running every year anyway, which is a problem. So there are a number of solutions to those problems, but those are the three things that I see. And markets have been on a strong run this year. S&P is up what, 18% year to date, something like that. And valuations just appear to be high on a historical basis. So that's what I'm seeing in the markets currently. What's going to happen over the next couple of weeks or months, I have no idea. But there are some structural things that are putting pressure on valuations.
Yeah, so let's dip into that, and it's funny, I almost forgot because it's so long ago that the Silicon Valley Bank and Signature Bank and those and was it First Republic, I think it was,
Mm-hmm.
that they went under, and I almost forgot it was like March of this year. It
Yeah.
seems so long ago. But you mentioned that the other small regional banks got downgraded recently, and I started laughing to myself because I just saw The Big Short movie last week. I love it's like one of my favorites. I've seen it like 100 times, but I saw it
Yep.
again, and I just remember that scene where they're sitting in where I forget the guy's name, but Michael from Office Space, sitting in the office with the rating agencies, and they're just like, yeah, sorry, we have to make money. And it's like, if they downgraded the regional banks, how bad must they be to actually downgrade the regional banks?
Yeah. Yeah.
you
Great
know,
scene. The woman's having problems with her vision. She appears to be a little. It's like the least desirable job on Wall Street. I mean, you get pushed around.
yeah, yeah. It was like the scene where he goes and visits the girl who's works for the SEC, and she's like, "Oh, I'm not here for this. I'm here to get a job in Goldman's desk."
Yeah.
Like, I mean, it's such a hilarious movie if you understand how the system works and Wall Street works and how everything works. If you understand it, it's like it's hilariously crazy, right? And they made a movie and made it funny, but it's so true. It's like
Yeah.
it's not possibly funny other than the fact that you can't imagine that this should even be allowed. But regional banks. So it makes me wonder, we have high rates. We've had high rates for a little while. My opinion, as I've been saying on the show for a long time, is we're going to have higher rates a lot longer than most people think. Like, I think that's inevitable. I think I don't see a way around it. However, where are the places? Where are the like? I guess where are the hidden landmines right now? Because a lot of areas in the economy, you mentioned one, commercial real estate, that get affected by higher rates. And we haven't seen it. The market's close to all-time highs and everyone's great. There's money raining from the heavens, everything's easy, and yet we have all these problems. So there's a disconnect. So where are some landmines you think people should be thinking about?
We mentioned commercial real estate. Residential real estate is another area that we're just kind of waiting around on, right? People have so higher rates. Mortgages are north of 7% right now, and there's a huge demand for housing. Rents are very, very high, and people are just disinclined to move from the homes that they own. If you've lived somewhere for 10 or 15 years, maybe your house is a little bit too small for your family needs, but you're paying 3.25% on your mortgage. It's a lot more expensive to go purchase a bigger house at north of 7%. So people are just kind of staying in place, staying put where they're at. That, I think, can persist for a little while, but not permanently. You need to move, right? And it seems like we are trying to build, and this is very regional, and I haven't dug into the regional differences to be totally honest here, but we're in California where I live, developers are building a whole bunch of new apartments, they're building a whole bunch of new houses, and they're trying to catch up to the demand to move. But rates being high are it just puts a huge headwind against that. So at some point that dam will have to break as well. To be clear, I don't pretend to have any idea which sector is going to get hit first, or whether, we're in for a huge recession or huge market calamity. I tend to be long and strong all the way through because I know I can't predict that personally, and that's just a personal investing philosophy that works pretty good when you zoom out, over 10 and 20-year cycles. But I would say residential real estate is something to look at if you're really concerned about what markets to avoid.
So this brings up an interesting question. And we've had some people that I respect in their real estate prowess on the show, and I have an opinion. Many of them have a different opinion, and I was thinking about it this morning as I was picking up the mail. I was thinking I possibly could be wrong, which of course is always something you want to be thinking about. So the balance is affordability versus supply and demand. Everyone thinks supply and demand is driving the ship, right? Which is there's no supply because people aren't moving, right? And then there's affordability, which is people can't afford to move, right? So in some ways they're both right. But in other ways, people are building homes still and they're trying to address it, but people just aren't moving because they don't have to. Like if I'm going to, let's say I live in $1 million house and my kids move out and I'm going to downsize to a $500,000 house, I'm going to have the same monthly payments for half the house. Why would I bother moving? Right. So I can have a smaller house and the same payments. It doesn't make any sense. You downgrade to lessen the payments. So I guess the question is which is more important in your opinion, and where do you think things are actually going to change? Because as long as people aren't moving, there's no supply, which means that house prices aren't going to drop, because if they do drop, no one's going to accept the drop, so they're just going to stay. So how do you think this is all going to pan out?
Both of them are important factors. Which of those two factors is more important? I don't know. I would probably have to lean toward supply and demand, because this isn't a good we have a whole lot of discretion over whether we consume, right? Back to your economics 101 classes, this is a somewhat inelastic good. We have to have somewhere to live. And yeah, homelessness is a completely different issue. But affordability certainly plays into it too. So how does it play out? I don't have any idea. Yeah, that's simply beyond my pay grade. But it's a sector where there appears to be some weakness, and I would be wary of over the next maybe 6 to 12 months.
Yeah, yeah.
What are your thoughts?
Uh, yeah, I mean, I go back and forth. So my opinion has been affordability is the most important. The way I think about the economy and the way I think about the markets is what is the most important lever? What's the one lever that's going to move everything else? Now, for the last 20 years, it's been basically the Fed's funds rate, right? Where is and printing money or basically destroying money has been the one factor that has been the most important thing. Are they printing money or are they not printing money? If they're printing money, the markets go up. If they're not printing money, they go flat or even down. And even in March, when the banks failed, they were basically destroying money, and they had to print a bunch of money afterwards to bail out the banks. So it didn't have the same effect. So that has been the most important factor for the last 20 years. But now I think things have changed. We're in a new paradigm where you have higher rates because the last 20 years rates were zero. So for the last last 18 months, or not 18, but 12 or whatever, it's been 5.5%. That is a big impact. I'm renting right now because we sold our place last year and we're waiting to buy and we're waiting for price to drop. I don't know. I don't know if it's ever going to go down, right? Like we're in a market where it feels like Alice in Wonderland, where, things aren't making sense. And when things don't make sense, it should cause you to just take a step back and why doesn't this make sense? What am I missing? What is everybody else seeing that I'm not seeing? Now, it could be that you're the only one seeing it, and when everybody else sees it, there's going to be a rush for the fire exits, right? That's one scenario. The other scenario is people don't care. Another scenario is there's something we're drastically missing. And so I always come back to this, rethinking the question of what is the one lever? And in my opinion, the one lever is affordability. If you can't afford to live somewhere, you're not going to live there. Supply and demand aside, I can either afford to live in my area or I can move somewhere else, right? If there's no houses on the market, I can't buy anything. But they're interconnected. So if, in my opinion, there have been plenty of houses in this area 4 years ago. It's not like we all of a sudden had a rush of 20% increase in population, right? That hasn't changed. So to me, the supply and demand isn't the problem. It is in a sense that people are cutting supply because they're not moving. But, you know, if you need a place to live, you can always find one. They're around. It just may not be in your most desirable area. So in my opinion, as long as affordability is where it is, things aren't going to change, which means it's the lever. Now, the thing that could change that is either lower rates or lower real estate prices.
Mm-hmm.
That's the only two. Those are the only way it could go. Either the market is going to sour because the Fed's not going to lower rates where the market is now, in my opinion. But either they drop rates, which should cause things to be more affordable, or real estate prices drop where they balance out and they become more of an equilibrium. I mean, that's my opinion, but no one seems to have a great. Everyone seems confident in their answer, but at the same time, there's no real easy answer. So I don't know. That's my 2 cents anyway.
Yeah, yeah. I think the trajectory of we really increased rates rapidly, and that has a lot of downstream effects that we simply haven't seen yet. And I mean, the yield curve has been inverted here for quite some time. We're not really sniffing a recession yet. We could be. There seem to be these areas of weakness, but the markets don't seem to be terribly concerned about it. And if the yield curve does not lead to a recession, that would be the first time that's ever happened. I want to say in the last 50 years, right? There have been maybe a dozen or 15 cases of inverted yield curves, and every single time it's predicted a recession. So we're a couple of years off from something happening. But I mean, hey, maybe the Fed is threading the needle, and we are headed toward a soft landing. It's really an odd market at this point. And
So
that's for that exact reason. I don't have a whole lot of conviction either way. I just and there's another argument for being long and strong all the way through, good times and bad.
So you're a smart guy, so I'm going to ask you this question. I think most people wouldn't have even thought of it. So the inverted yield curve typically precedes a recession by, I think it's 18 months or 2 years. I forget what the marker is that they have. But no one ever says why. So why do you think an inverted yield curve precedes a recession? Because I think the reasons for it 40 years ago have changed. So, why do you think that's still a factor? Is it just correlation? People are like, well, it's correlated, so we'll just say yes, or is there a causation behind it?
I don't know that. I don't know, to be honest, Kirk. I think that the markets tend to be pretty smart. I think that the bond market is really vast, which is, and your listeners are probably familiar with all this because I know you talk about it a lot on the show. But when we say yield curve, we're talking about the level of interest rates across different maturities. And usually in a healthy market, short-term interest rates are a little bit lower than long-term interest rates. And investors, if you're going to lock money up in a 20 or 30-year bond, usually you want more interest in return because you're locked into that rate for a longer period of time. And where we're at right now is an inversion of that curve. Short-term rates are higher than longer-term rates. And is that a correlation or causation? I mean, this is probably not the answer you're looking for. I really have no idea. It's if I were an investor in 20 and 30-year bonds, I would certainly want more interest in return than what's being offered in the markets right now. And, it's an argument for going to short-term cash. And we have more options available to us today than we did years ago, whether that be through T-bills or a high interest savings account or some combination of the two.
So, I've never heard a great answer for why the yield curve precedes a recession. The best I can determine is that it messes up the banking cycle because people effectively aren't. They're not able to make money in the normal way. The banks are actually losing money. However,
Yeah.
the banks have changed since the old school, like, borrow it. What was the term? Like, borrow at 5, lend at 7, out by 5. There was some like there was some like little quirky thing that talked about that they don't work very hard and they're out in the golf course by 2. But the point is that typically in the old cycle that's how it worked. I don't know. I mean, that doesn't happen now because they make money from other ways. And but it just to me it always seemed interesting. Like it was never like a real good reason. It just was correlation. It could be causative, but we just don't know what it is.
Yeah.
Okay, but just curious. I mean, I don't have a great answer either. Just thought I'd pick your brain. So let's get into federal government debt finance. So this has been fascinating to me because prior to COVID, I think it was 30 or 40% of the government revenues were going to pay interest rates, like their interest payments, was something
Hmm.
along those lines. But now that rates are higher, that's probably even more. So, I mean, I I guess it raises the question of like what's going to break open the facade here that everyone's kind of portraying and everything's rosy and there's nothing to see here. What is going to cause that to change? Because at some point it's unsustainable. We may already be there. I don't know, but how do you see that playing out, and how do you see that relating to the markets for investors? Because this is for investors. I mean, whatever the government does, they do. But how does this relate to investors?
Yeah, yeah, yeah. I seem to be I don't want to look at things through rose-colored glasses ever, but I think we have a little bit more room to run with this this issue specifically. So here's the problem. We have a government where we spend a lot more money than we take in every year through tax receipts, right? And if we compare that to what you and I do in our personal households, they're apples and oranges, right? Individuals you don't want to spend more than you're earning until you get into retirement. That this doesn't work for an individual household. Governments can do this, particularly when the US dollar is the world's reserve currency and you have all the guns and ammo and the biggest military in the world. So governments, we're spending more than we're earning through tax receipts. You have to borrow the difference somehow. That's how the math works, right? And so at some point, we need to start looking at our total level of federal debt, how much it costs to service that debt, and then compare it to economic throughput of the economy. And usually we like to measure that through annual GDP. Historically, you only have so much room to run. Your total federal debt as a percentage of GDP can only become so high. But when the US dollar is the world's reserve currency, we have a little bit more room for that to run, right? So there are only 3 ways to balance the scales and fix this problem. Number one, you can spend a little bit less, which politicians don't like to do because it's hard to get reelected when you spend less. That seems like it's unlikely to me. Number two, you can raise tax revenues either by increasing the level of tax and thereby bringing more cash into the federal coffers, or by maybe shaking up the economy somehow and pushing more throughput through the system to where your GDP is larger and at the same tax rate, then you have more money going over to the federal government. Or number three, you can just print more dollars because we control the printing press, right? So there are only 3 mathematical ways to fix the solution. The first one, spending less, is unpalatable for politicians. The second one, raising taxes, also very unpalatable for politicians. The only 2 viable options here are do something that stimulates the economy or print more money. It's a lot easier to get reelected because you print money, it doesn't really hurt us now or tomorrow or next year. It hurts us 10, 20 years down the road, right? So that's primarily where I see this going. And I think our debt to GDP ratio is maybe 110 to 120%. Does that sound like it's in the ballpark?
About right. Yeah.
About right?
Yeah.
Historically, you have more room to run than that. Now, I don't like the fact that we add to the federal debt every single year, but we can continue to do that for a while longer. I'm concerned about my kids' generation. I'm not terribly concerned about my own. So your question was, how does this impact investors? Well, I am a big proponent of diversification. I like to have US and non-US assets. I think that US dollar denominated assets are probably going to be okay comparatively for a little while longer. But you want to have some diversification in other currencies too, because if if any of those things comes true other than, right, so four options, you cut spending, you raise tax receipts by higher tax levels or by putting more economic throughput into the system, or you print money. The only one of those four that is really okay for US denominated assets is more economic growth at the same tax rates. Any one of the other three options hurts your US investments. So that's how I think about this, and I'm curious what your thoughts are on it too.
Yeah, it's really interesting. You raise a great point of U.S. versus international and currencies. We don't talk a lot about currencies on the show because it's complex and everybody here is, well, not, I shouldn't say that. There's a lot of people here international listen to the show, but most people here are U.S. centric, and people who live in the U.S. are pretty much, they don't know there's a whole world out there for the most part. Like, yeah, I know we all do, but tongue in cheek, we don't see the cross currency issues because people don't travel. If you're in Europe, like they have a currency changer on every corner, like not with the euro so much, but in the old days, like that was the thing. Like that was just part of culture. Like you changed countries, you changed currencies, you tried to figure out which one's moving where. Like that was a thing, right? And it's still a thing globally. It's just there's fewer currencies to trade, larger currencies. Now you just got the euro instead of all those European countries. You still got the euro, the yen, the dollar, the Canadian and Australian dollar. Like there's still some currencies that people trade, but I think for most people it's a challenging area because it requires a lot more understanding than I think most people have of the world. And but when you mention investing internationally, that's been interesting too. So if I think about the markets for like the last 20 years, right? Where were the best places to invest? Well, the US was the best place to invest. Where else? Big tech was the place to invest. I mean, if you think about it, growth was a great place to invest. Value was not, for going on a long time, over 15 years, probably closer to 24 years. Value it's had fits and starts. Like once in a while it has a bump where it does well, but generally it's been growth environment, and international has been lackluster because everyone feels like the US is safer, especially now in Europe. I mean, Europe, their stock market's not booming, it's not busting, it's just kind of stagnant. But, there's conflict in Europe. There's no conflict here. I mean, there is, but in different ways. So I don't know. It's interesting because if you really want a diversified portfolio, I mean, you're a CFA, so you know all the math. Looking historically, if you're diversified, that was I know people say it's a risk management tool. I call it a volatility management tool, but realistically, you should be more diversified. But it hasn't paid off in the last 20 years to be diversified. So it kind of begs the question, like, is this a different environment, or are we just shoving stuff under the rug and hopefully someday, at some point somebody will trip over it? But I don't know. I mean, what are your thoughts? Like, does it make sense to continue to diversify, or are we just, is it going to be 30 years from now? We're just like, well, I guess we still should diversify, i.e., have 7 tech stocks instead of 5. Like, what does that look like? And at what point do we hit a wall where we can't keep investing in big tech anymore? We actually have to invest in the real economy.
Yeah, the old saying on Wall Street goes, being diversified means that you're always saying that you're sorry. And that's I think it's still very important to be diversified. We as we're talking about, I do think that we have some room to run. It's very likely that we're going to print more money to continue financing our deficits. That'll prop up US dollar denominated assets. At some point, that dam will have to break. It might be 20 years down the road, it might be 50, it might be 75. There are these big structural changes that occur around the way that the world economy works. Right now, the US dollar is kind of the safe haven, not just because we have the biggest and most diverse economy in the world, but because other, well, let's say that you're an Australian company and you produce ice cream cones or something like that, and you ship it to Indonesia. Well, an Australian producer is not going to want to deal in Indonesian currency they're going to want to deal in US dollars because it's more stable. And on top of that, both the company that they're selling to in Indonesia and the ice cream cone maker in Australia want to access the US market because we have the biggest, strongest, most diverse economy in the world. So we have some room to run there. That being said, this is going to become a big problem at some point in the next 100 years or so. And I think being diversified is really, really important because it always seems to be some unexpected risk that is the straw that broke the camel's back, and which unwinds a whole lot of these issues. Risk is another old Wall Street saying is risk is what's left over after you've already thought of everything, right? And being diversified is the perfect margin of safety against that. We can, you and I can sit here and talk and identify all these problems and all these issues, but even if we're right, it's really hard to get the timing right, which is why we've seen so many short hedge funds over the last 10, 15, 20 years just go belly up. They had the right arguments, they identified all the right stuff, they just got the timing wrong on the trades, and you can go bankrupt because of that. So I think it's been important to be diversified, even though it hasn't really panned out that well, as you pointed out. And I think it's going to continue to be important.
So this kind of brings up a more specific issue that we're facing. So I know, people tend to talk about big tech or not much else, right? Oh, really? There's a whole rest of the economy. It's not just, just not just the Magnificent Seven, I guess what they're calling them now. But I started scrolling through some of my feeds that I read, people that I think are smart enough, not major media, but just people I follow. And I saw a lot of news. And what was interesting to me is, like, in the last week, I've seen nothing but negative earnings reports or disclosures or what have you. And I feel like, this last year was rough for a lot of people, where everything went down. This year, everybody's in Candyland, like everything's great and there's nothing wrong here. But to me, it just seems like that's a superficial look at the world. Like, the real economy is slowing down, and we're starting to see a lot of signs of that. And so I guess the question I would ask you is, what are you seeing when it comes to earnings, and how important are these differences to the markets? Because the markets are, what, 30% run by 5 to 7 stocks. I don't know the actual math, somewhere in there. So it's really dependent upon those Magnificent Seven to dictate the returns of the market. So how do you see that, and how do you see earnings, like, affecting things and changing in the near term?
Yeah, this might be part of the sea change that brings some of the valuations of these things back to more reasonable levels. Growth, and you made the right point that U.S. growth has really been the only game in town for quite a while in this era of easy money. Now we're starting to get some negative earnings trickle through. Maybe it's starting to normalize a little bit. It seems to me that you have growth assets, you have value assets. I tend to be a little bit more on the value side because I care a lot about what we're getting in exchange for the dollars that we're investing into something. So growth has been propped up dramatically over the last 10 years. You have the earnings that you are receiving in exchange for the price that you're paying, right? Your ordinary price to earnings ratio. You can always also look at it a price to book value of equity, price to sales, any of these other valuation measures. Tech stocks are still really, really expensive. And so we've had a dramatic rise in interest rates that hurts profitability of all corporations, not just tech stocks. And now earnings are starting to turn and show negativity. Again, I don't know when the timing of this is going to happen, but when market sentiment turns and you wake up on a Monday morning and the headline is that, something to the effect of investors flee tech stocks and go to safety of more value-oriented securities, it all just happens all of a sudden. It's not because there's, one piece of news that's announced and now all of a sudden favors value assets more. It's that they just become more comfortable with your Chevrons and Coca-Colas of the world that are a little bit less expensive relative to what you pay for and what you get. So my preference through, again, good times and bad, is more of an equal weighted approach. You're not going to be overexposed to growth stocks if compared to if you're investing in like an S&P 500 cap weighted fund. It's just equal exposure. And I know I didn't directly answer your question, but that's typically how I like to think about this stuff is just don't have too much exposure to one area, limit your risk, and just continue to be diversified. You're far more likely to get a better investment outcome when you're looking back on it over a 40 or 50-year period.
So it raises the question because value stocks typically are interest rate sensitive, right? And that's one of the markers of value stocks like banks, materials, things like that. They typically tend to be more value oriented. So how are higher interest rates going to play into this? Are they going to, because value stocks are expensive too, like everything is. It's not like they're cheap. So how are higher rates going to play into earnings, and how long do you think it's going to take before earnings actually start to show this?
Yeah, they will be impacted as well, no doubt about that. But I think they'll be impacted less than the more bubbly, frothy growth counterparts that we see. So to answer your question, what we'd want to look at is the financing and term structure of each of these value companies or them collectively as an industry. To be honest, I don't have any idea what their debt financing looks like at this point. If they all have a substantial amount of outstanding debt, it's not going to come due for 10 years, they're probably going to be just fine. But if they're going to have to refinance at some point in the next couple, that's the period of time that I would really look at to be concerned about.
Okay. All right. That makes sense. So let's see here. So as we kind of get close to wrapping up soon, you know, tell the listeners, like, what should people be thinking about going forward? Like, what are some kind of best practices in this environment that people can use? What should they be considering? And, what are some takeaways that people can kind of leave with?
Yeah, fundamentally, I think it's really important to, and now taking a step back from in-depth investing stuff to more financial planning stuff, I think it's really important to have your emergency fund in place, right? Financial planning 101, just have enough cash on the sidelines to where you don't have to dip into any of your investments if we hit a point in the market with some turbulence over a 2 or 3 or 4 year period. You don't want to sell when assets are low. You want to wait for them to appreciate in value, right? So having an emergency fund is a good way to go about that. Even though we're in what's currently a rising rate environment, I also like to think of our bonds in our portfolio in a similar fashion, right? And back to your old 60-40 portfolio, if you're someone who's about to retire and you have $1 million, if you have 40% of your accounts in bonds, that's 400 grand. You want to think of the bond allocation of your portfolio as kind of a faux emergency fund, because typically bear markets don't last for longer than 3 or 4 years. If you're spending $100,000 a year, having 400 grand in bonds gives you 4 years to wait out the stock market and allow that to recover before you have to start selling those assets. So there's a lot of stuff going on right now. I think we have some structural headwinds ahead of us over this next 6 to 48 months. I don't have any idea when the timing of that's going to be, and getting your cash situated in a way that makes sense for you and your family and your own planning just gives you more runway to wait out a bad market if that dam does break anytime soon.
So one other thing I wanted to ask you before we leave, because I know you work with a lot of business owners, and big corporations have a very different economy than small business owners. In this environment, what should small business owners be thinking about, and maybe some best practices for them as well?
Yeah, so we do a lot of financial planning for small business owners, and a lot of that revolves around the exact same discussion, cash management. If you have, let's say, a single member LLC, or maybe you have some partners through an LLC structure, or even if it's an S corporation, both those are all types of pass-through businesses. And a lot of people are freaked out about taking cash out of their business. They're concerned about whether they have enough cash in the business. This is an environment where you want to have plenty of cash in your business. And from a tax perspective, it doesn't matter one iota whether at the end of the year you leave cash in the business bank account or you take it out and put it in your personal bank account. These are all pass-through types of businesses. So you're taxed on that money either way. If it's a C corporation, that's a different set up a different structure entirely. So where I would start is I would take your operating expenses in a typical month from your P&L, and then I would want to have somewhere between 3 and 6 months worth of operating expenses in the bank if you can afford it. Now, that's kind of a wide range, and it's going to vary a lot by industry. If you're in professional services like you and I are, Kirk, we typically don't need quite as much cash in the business. If you're in a more capital intensive type of business, manufacturing, something like that, if a piece of equipment breaks down, you want to have plenty of cash available. But if we're seeing big corporate earnings be turned in that are negative, and the yield curve is inverted, and it seems like things are slowing down, and we have some headwinds ahead of us with regard to the way that debt is going to be need to be refinanced at the federal government level and all these other sectors. Those are some signs that things might be slowing down a little bit, and I think you just want to have enough cash on hand to weather the storm, so you don't have to go in debt at a high level of interest yourself.
Yeah, with interest rates the way they are, doesn't make sense to borrow money. Credit cards at 20%, 30%, with borrowing money I mean, mortgage rates are 8%. It's crazy to think about. They were 2.5 years ago.
Yeah, that's right. So simple answer, right? But just think about having a little bit more cash in the business account. But that's a lot of what it comes down to. You want to stay in the game. If you're in that situation, you own a business, and part of your net worth is tied up in the value of that business, it's imperative to stay in the game. And having a little bit more cash is just a margin of safety that allows you to stay in the game.
Nice. Well, Grant, I really appreciate you coming on the show, sharing your wisdom with us. Always enjoy our conversations. Where can people find more about you?
Yeah, check out threeoakswealth.com. I have a podcast that you came on last summer. As you mentioned, had a really good conversation about inflation. It's called Grow Money Business. And if you Google either of those things, there's plenty of stuff that'll pop up.
Awesome. Well, Grant, once again, thanks for coming on the show. Appreciate you coming on, and we'll have you on in the future.
Yeah, thanks for having me, Kirk. Great chat.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, so now we're into the panel portion of the show. Really appreciate Grant coming on, sharing his wit and wisdom with us. And now we're going to talk with our very own panelists. We have Barb Friedberg. Hey, Barb.
Hey, but I got a bone to pick with you guys. I didn't get the memo that I was supposed to wear a black shirt today.
Black shirt day, Barb. You're not with it. You're not up with the times.
No.
Barb,
okay.
you're always one of the more colorful people
I'm a
on
little
the panel.
depressed.
Yeah. You're here to bring color to our color commentary.
Okay.
To be fair, this is actually not a shirt, so this is a fleece. But
What
anyway.
also means that as we talk today, Barb, you need to be the positive, and we will go with the more negative view, and then we'll just kind of keep with our color schemes.
Got
Nice.
it.
All right. Well, also as you've met, we have our very own Doug Heagren. Hey, Doug.
Hey, Kirk, how you doing?
Good.
Leaves nothing left to be introduced, but it's good to see you again, as we often do talk, and this is a fun one today. I can't wait to get into, because a lot of what he talked about is financial planning, core 101 stuff. So excited to talk about it.
Well, let's just dive right in. So, Barb, what were some of your thoughts from the interview?
I always like talking about the economy, interest rates, the stock market, the basics. But I think the thing that really struck out in my mind, and you guys discussed this as well, is what the heck is going on? You know, things are not how we expect them to be. Valuations have been high through the up market. I mean, stocks aren't supposed to be this highly valued right now. It makes no sense. Interest rates are rising and the stock market is increasing, except for a pause this week. But the yield curve is inverted, which means long-term interest rates are actually delivering shorter yields than short-term rates. Well, that's supposed to precede a recession. It's just, we're kind of topsy-turvy. People can't buy a house because interest rates are so high, but prices aren't coming down. So I'm like, what's going on here? I loved your comment, Kirk, about we're being in an Alice in Wonderland world where nothing makes sense. So hopefully we can unpack this together, you guys.
Well, we're gonna definitely get into that. There's a lot to talk about. It's crazy times we live in. But Doug, what are some of your initial takeaways?
Well, going back to what Barb said, I think I just want to grab some treacle, because I feel like we're just at the tea party with the Mad Hatter. My big takeaway here, to me, is one of the things you hear a lot with economic cycles and conversation is this time it's different. And most of the smart minds in the room roll their eyes and go, no, it isn't. But this time around, it is different. And you and I have talked quite a bit, Kirk, about how there's a lot of what's going on here that represents what, the stagflationary forces of the 1970s. But one of the things that's very different this time around is that when the 1970s occurred before, we had similar oil issues, which we'll see where we get with that. But we also had high interest rates, but we also had very low valuations. I mean, the stock market did pull back, and it was in a period of recessionary forces that kind of grade some values. Housing was still very inexpensive. I look at the house that we had bought, not the one we're currently in, but we were the third owners, and at the time that the second owner bought it, I think it was built in the 60s. The second owner bought it in the late 70s. And it had gone from like, what the ridiculous post veteran home, that's what those were. And I think it was in the 20s, thousands. And then they sold it or bought it. The second owner bought it in the 70s. That's it, $70,000. By the time we got around to buying it in right around 2012, it was up to $400,000, right? So now you look at what's happened with housing and other valuations across the board, like the stock market. Most people would agree overvalued. You look at housing, most people would agree overvalued. So now, again, what we have is high interest rates, but we now have high interest rates against an economy that is unaffordable for most people. So they can't afford the money and they can't afford the goods. This time, it is different.
Yeah, and I think we're gonna have a lot of Alice in Wonderland quotes today, because it's so perfect. Why sometimes I believed as many as 6 impossible things before breakfast, and that leads me as a segue into Barb's prior thought of what is going on here. So Barb, you've been around the block for a few times and you've seen a lot with your own portfolio management. What's going on? Like, this is all crazy. Every day I wake up and there's 6 impossible things happening in the financial markets, and none of them make sense. And yet, people just don't seem to care. So what do you make of all this?
Well, and the other topic that came up in the interview I thought was so prescient was, should we question diversification? I mean, clearly we talk about this. I'm a huge champion of diversification, but I'm waiting for anything but the tech industry to outperform. I just wrote an article for Forbes Advisor on the top tech mutual funds. And as part of that article, we list the 10-year average annual returns. They were hovering around 19, 18% for every one of these tech funds. First of all, I'm thinking to myself, why the heck didn't I buy these 10 years ago? Okay. But also, I'm thinking, how can this be that there are just a couple of sectors that have been just hitting it out of the park, and everything else is like, ho hum? So that's one question. And then the diversification. I am a global investor. The US is only about 60%, 55% of the entire world investment markets. And yet the returns on the S&P 500 have hugely surpassed those of international markets, not just for 5-10 years, but for a really, not since the beginning of the turn of the century have international stocks delivered any type of comparable performance with the US. So does that mean we should stop diversification? Well, I still don't believe we should, because I was just glancing at my portfolio recently and looking at the recent outperformers. And I have seen, like, I have a mid-cap value fund. I have seen that do pretty well. I've seen a small cap value eke out some gains better than some of my other holdings. So I think what this points out is you really have to be a long-term investor. And the tech stock boom is not going to go on forever. I lived through the 2000 internet bubble bursting, and boy, did it burst. So end of 99, I can't tell you how many people were saying, my stocks went up 70% this year. Yeah, this is great, blah, blah, blah. Well, then comes 2001, and those stocks fell. They fell hard. We experienced a lot of market declines the beginning of the turn of the century, and many of those have not rebounded. So despite the confusion that we are all having with the current market, I have to believe that you need to be a long-term investor. If you need your money this year, next year, within 5 years, don't put it in the stock market. And at some point, if any sort of laws make sense of economics, we will revert to a fair valuation in our assets and a trading of the outperforming assets.
I'm not so sure, Barb. It takes all the running you can do to stay in the same place. If you want to get somewhere else, you must run at least twice as fast. If you think, sorry, I'm going to keep quoting these. For those of you who don't know them, you might be missing the joke. Anyway, but I mean, honestly, look, this year and in the last 20 years, if you were in big tech, you would have done great. And if you weren't in big tech, then you would have done mediocre. And I think all the value investors, and Barb's a value investor, I'm a value investor, Doug's a value investor, I'm sure we invest in other things, but, I think we look at the world from a value lens, and we would have done subpar. But yet, historically, growth and value have done very similarly. They've done relatively even, depending on when you look at it. Right now, growth is high, so growth looks better. In bad times, value looks better. But generally speaking, they're balanced. So the question that comes up is, is the market broken? I mean, some significant changes have happened in the last 24 years in the markets. Is the market now broken, or is it going to revert back as Barb said? What do you think, Doug?
I'm going to throw out something here. that's food for thought. And I'm going to throw this out based on what I just said about this time it's different. We've talked quite a bit offline, online before about The Big Short and kind of what happened with the recession, the 2007, 2008. One of the big takeaways in that movie is that although all the economic data said, we have a problem here, Houston, right? Let me quote it right to get the movie right. Houston, we have a problem, right? What happened is the real estate market just kept going. The debt swaps just kept going. And we had got really smart minds in the room saying, what's going on? We're shorting this, and yet it keeps going up. One of the things that was uncovered is one of the groups worked under Morgan Stanley, and Morgan Stanley had such long bets against real estate that they weren't allowing real estate to collapse because their own personal impact that would have. Okay, so they were betting against their own team, right? Well, here's a this time it's different issue. That was an isolated scenario back then. But guess what's become the reality now? And the reality now is that we have a situation in the new economy or the new market where, because of the advancement of passive index funds, the advancement in the continual growth of 401ks and other retirement accounts, that the combined assets of three companies, BlackRock, Vanguard, and State Street, control 82% of the S&P 500's market capitalization. Now, that was as of 2018, and 73 to 80% of global ETF assets. Trillions of dollars continue to funnel in through them, and it gives them over 25% power in controlling the boards of companies, okay? But these companies control so much of the assets, so much of these companies that again, are we running a situation that part of what's going on with the markets is this kind of self-fulfilling prophecy, this protectionism, because of how much how much control that they have? And what are two of the areas that we've seen some of the biggest growth over the last 10, 15 years? Technology and real estate, right? Well, guess what? The number one owner of real estate in the country is? It's Vanguard. Now, people talk about BlackRock because they've been a huge investor in it too. But if you go down a list, I was looking at a list of different real estate companies and various facets of real estate. Vanguard has over 16% ownership in dozens of these real estate entities. Okay, so what we have that's different this time, and again, causation, correlation, we talk about all the time. I don't know if it's directly affected. This is my own observation and opinion that I'm throwing out here. But you have three entities controlling almost the entire global market. And then what you have on top of that is, because of access to information, because of the world that has evolved first it was kind of robo investing, but then you got into things like Robinhood, and you get things like, more and more people that are getting direct information. I mean, I'm out there on social media. I see it. More people are just saying, look, the only way to go through and invest is just to keep buying the dip, keep buying, keep investing, keep investing. So I think that there is somewhat less of a reactionary fear-based, definitely more of a passive-based approach that just says keep putting money in the S&P 500 under all circumstances. And then when that is controlled by three entities, I think there are some things here that, whether or not they're causing this issue or even correlated to this issue, this is something that's different. We've never had this much of the global economy controlled in such concentration in the history, other than maybe going back to the Rothschilds, back in, and again, but I'm not going to go down that path. But the point being, this is definitely something new. And I think it comes back to, is that diversification going to help? Are there things that we can do? Or, as you said, Barb, and as was said in interview, Kirk, listen, we know that we can kind of go down the segue now, the diversification, the 101. Where do we hold into it? Well, guess what? We talked about this. The markets can be irrational longer than you can stay solvent or you can stay patient. Every time people say, well, you know what? We got to be diversified, got to hold value, got to hold this. The market just keeps ticking along with real estate and technology and growth. leading the area. And it's making, as he said in it, diversification means always having to say you're sorry, right? Well, it's making a lot of people have to say sorry for a long time. That's also forced a lot of your active managed funds to go ahead and stop saying sorry. They've had to chase growth, more and more and more of a push there. I saw something the other day that once again talked about how the allocations to growth have skyrocketed again in portfolios and money managers and hedge funds. Why? Because you got to chase that return, because if you don't, then all of a sudden you have to say sorry. But investors aren't as patient as they used to be, going back to the longer term. If you're not getting the return that somebody else is emotionally, they fly towards that greed, which is forcing everybody to pigeonhole into the same concentrated investment. It's going to have an impact, but as he talked about, who knows when? And that's the problem. It could take a year. It could take 10 years. If it's a year, you're going to be glad you diversified. If it's 10 years, you're going to be pissed.
I totally agree, Doug. And there's no use going back to yesterday because I was a different person then. So Barb, question for you. I've often seen a cat without a grin, but a grin without a cat, that's the most curious thing I've ever seen in my entire life. What do you make of the inverted yield curve? You mentioned this before the show. It's crazy what's going on. And you talked about before the show that you have a lot of research into this because it's very curious and a lot of people don't understand what's going on. So what do you take of this?
I want to address that question, but I first want to respond to Doug, because when you talked about like Vanguard and State Street and BlackRock controlling the investments, I think we need to clarify here. Those are fund families who have put out the ETFs and the funds that own these companies in the S&P 500 and in all the diversified index funds. Those are the big index fund providers. So they created them, but they don't control them, because each of their funds are made up of individual companies in which investors buy. So, for example, I might own SPY, which is a U.S. market exchange traded fund, I believe, put out by Vanguard. Not even sure which one, but it's one of the three. But so I own shares in that. So I think you're giving, they have a lot of power in that they're making money off of me owning their fund, but they can't control it.
Well,
so I'll give you a chance to respond to that, Doug.
I will add to this. They do, correct. Your individual investors hold these depending on your shares. And of course, from that, they will get the option to invest in the proxy of these companies. But they're also funneling trillions of dollars continuously towards these holdings through that access point, right? But at the end of the day, most individual investors don't do anything with response to the vote, right? So they do control, because at the end of the day, once quorum's hit, and that's the only thing they care about in terms of getting the proxy, the controlling managers of those investment portfolios do get the control of how those votes get relayed. And let's not kid ourselves. There's a tremendous amount of power in that.
Got it. Okay. Yeah, I'll give you that. Yeah, I think that's true. So when it comes to the voting time and the proxy shares, and for our listeners who don't know about that, every investor has an opportunity to vote on issues that come up before the funds at annual meetings. And those funds do have a big say in how those issues are addressed. So I'll give you that. And
it does trickle down then to the impact and the decisions that are made throughout the economy from there.
Okay, yeah. So glad we got that wrapped up. So inverted yield curve. And as we've discussed before, typically what that means is if you're looking at the interest rates on a long-term graph, And you'll see right now, you can get a short-term interest rate on a 3-month T-bill in the neighborhood of 5%. And yet, if you go out on that graph and you look at the 10-year bond, government bond, it is lower than 5%. And so intuitively, in a healthy market, you want long-term rates to be higher than short-term rates, because you are risking more by tying your money up for a long term. And for that risk, you deserve to be paid more. That is not happening. Historically, since the 1970s, according to the Chicago Fed, who should know what they're talking about, every time there has been an inverted yield curve, it has preceded a recession. On the interview, we discussed, or we didn't discuss, Kirk, you discussed with the guest that we really don't know why. So I said to myself, well, somebody's got to know why. So I went to the Chicago Fed page, and they're not sure either why this happens, because there's so many components of both the interest rate path and the risk premium. And the risk premium principally means how much am I as an investor going to be require in terms of excess return in order to take on greater risk. So what they say, if you want a little understanding of why the inverted yield curve might be occurring, there's a lot of components. One of them is expected rates, and that's long-term rates, are shaped by what we think the future is going to bring with respect to inflation. It's also determined by bondholders' concerns about interest rates. Do we think they're going to continue to go up? Do we think they're going to go down? And so the slopes, or the trajectory of these interest rate graphs, they're based on the expectations of where interest rates will be in the future and how much investors demand to be paid for the risks they're taking. So, long story short, to sum up the gobbledygook I've just been discussing, is we really don't know. We hope that long-term interest rates will be higher than short-term rates, because that's a healthy scenario. Right now, given what the Fed is doing, it's looking like rates are going to come down next year or the year after. And so long-term rates, the setters of long-term rates, don't want to set up a high long-term interest rate when the short-term rate's going to come down, and they would have been able to borrow money for lower rates. So, to sum it up, are we going to get a recession? You know, if history is any guide, at some point we probably will. There's a lot of factors suggesting that, and what long-term rates are going to be in the future, I think they're going to continue to go down, because the Fed has pretty much told us long-term interest rates are going to go down. So just one more thing, which is, so what's an investor to do? And I hate to say this, guys, but because nobody knows the future, you're really best off to diversify. And with the cash that you have in your portfolio, it's tough to turn your back on 5% short-term interest rates. And so most investors are keeping their maturities kind of short. But when we get to a peak in interest rates, and before they start to go down, you might want to lock in some intermediate term fixed income, because as interest rates go down, the value of your bond holdings will go up.
Well, Barb, that's very comforting. My conclusion for what you said is the Fed has no idea what they're doing, and yet they're predicting rates are going to go down. It seems like most everyone's mad here. Doug, I'm going to turn it to you. Why is a raven like a writing desk?
Cute. Thanks, Kirk. I remember the quote. I can't remember the other details on it. Well, look, listen, you can ask me to quote song lyrics all day long. Movie quotes, I'm notoriously bad at. But
that's my strength, by the way. I don't have many, but that is one of them.
Wonderful. I'll sing, and you can quote the movies, and we'll be completely equally annoying to everybody. So
as long as I don't have to sing.
Right, there you go. Listen, here's what I'll put at it. And I'm going to go. He talked about something in this that I think is really important, and I know this is something we've talked about ad nauseum. But human nature, unfortunately, especially with this incessant amount of media access that we have now, which, by the way, going back to what I said before, most of the media outlets are also controlled like 25% plus by those big three. So, hey, they control everything. But going back to the fact that now with social media and every single other way that we can now get information, it has only exacerbated the issue that humans have with their inability to combat their own positive but also potentially destructive addiction to greed. Okay. And what we're talking about with markets is greed, right? We want what we want, and we want it right now. And if we're not getting it right now, we're not going to have the patience, and we're going to get it somewhere else. But that's not how long-term success manifests itself. As he mentioned, I loved his quote on there. Risk is what's left over after you've already thought of everything, right? At the end of the day, you humans only have a certain capacity to think of everything. I've talked about this before, the 911 dilemma that they ran into. They originally set, I forget what town it was. We'll just set it to be 1 million calls on the system because, we're not even close to that. And then one day it hit 1 million calls and 911 blew up. Okay. It forces humans to consistently try to outthink the technology that we have. And there's there's much documentation now that humans may be, especially in the world of AI, surpassing our ability to think at the level we need to think to ward off all sorts of possibilities that we are now creating for ourselves. And so at the end of the day, if you already have thought of everything, you probably haven't thought of everything. Okay. And that means there's going to be risk there. The problem with the desire to face greed is that humans will only battle the threats that we face right now. We are almost as a species, we are almost incapable of being able to prepare and understand threats that are in the future. We're constantly battling the interface, and it's getting worse as families are getting busier, things are getting more expensive, we're pulled in more directions. I just read something that talks about the millennials and Gen Z now are averaging about 10 different social media platforms, and they think they can handle that, right? And they said, you can't. Your mind's going on, off, on, off, on, off, on, off. Where am I going with this? What I'm going with this is it's going to continue to be a challenge for us to think about how that risk is going to appear, and we're not going to be able to see it coming. But when it comes, it is going to crush a lot of dreams, okay? It's always there. Risk is always there. Every time you get in a car, the risk of you getting in a car crash is always there. Doesn't mean you've been driving for 50 years, never had a crash. Doesn't mean there wasn't risk. It just didn't manifest itself. But when it does, it can end your life. And when we talk about the markets and the economy, that risk is always there. And when it manifests itself, it can end you financially. So what does that mean? It means that we have to have the maturity and the discipline to put the structures in place that will prepare for when that risk occurs. We wear our seatbelt all the time, even though I've never been in a car crash where I've needed it, okay? Because when I do, I'll be damn sure glad that I've got the seatbelt and that I've got those airbags. And they keep adding more and more airbags. And people will complain about that. I didn't think this still existed, but I drove with someone recently that still doesn't wear a seatbelt. It's like, really? In today's day and age? That was a real problem when they implemented it 20, 30 years ago, 40 years ago, whenever they were made mandatory. A lot of people are like, I'm not going to do this. But generationally, that's changed. This person was under the age of 40 and didn't use the seatbelt. So going back to the markets, we've got to prepare and we've got to think, yes, I know you want the greatest return right now, but this is a mathematical fact. There is more to be gained by avoiding losses than picking winners. Always. You say, but I didn't get that great 20% return. Yes, but wonderful. That 20% return at some point was offset by a 20% loss, which needs 40% plus to get back to where you were. And that takes time. If you lose 50% right now, they did some math after 2008 that showed how long, based on returns, it would take for you to just get back to even. And if you ended up with like a 3% return, it was over 14 years just to get back to where you were. Even if you get 7 or 8% a year, it took 7. That's 7 years of your life you're not getting back. 7 years of your working life you're not getting back. And people say, well, I'm now even. I've made it up. You've never made it up unless you can make up where you were and all the yield and return you would have made during the same period, which means the true getting whole doesn't happen for another decade. Well, guess what? If you're 20, that means 30. If you're 30, that means 40. If you're 40, that means 50. If you're 50, that means you're retired. You're not ever getting it back. So how do you go throughout that? I love that he talks about cash. Right now, I think is probably one of the easiest times to sell cash because compared to what we've seen, interest rates are pretty good in certain areas. You can go get 4.5%, and that sounds really sexy in this world we're in right now. Even though if you compare it to inflation and the cost of the things we need, really it's just finally keeping up with that as it always has. But I also want to say this goes beyond just cash. What we're talking about is cash equivalents. In other words, building your portfolio to have safety nets that are going to work and be consistent all the time so you can afford to absorb the risk of greed. That means cash. It means money market. It means CDs. It means annuities. It means cash value life insurance. It means lots of diversification. You don't go out on a golf course and say, I only bring the driver because, man, that thing hits 350, right? Well, that's great until that driver hits 350 onto the other into the water or the other fairway. Or what are you going to do when you're up at the sand trap? Got to bring a sand wedge. Geez, that takes up room in my bag. Yes, it does. But guess what? Eventually, when you need it, you're going to be very happy that you have it. Okay. You've got to have a bag of clubs. You've got to be able to diversify based on where you are taking that shot. And all of these things combined can work together to help you to do a lot of different things. I want to go back to the cash equivalents like he talked about. If you're going into a time where you're going to live in retirement and you're going to need these investments, one of the things I learned years ago is what I call the farm. Okay. What is the farm? The farm is, if you think of the way a farm runs and you've got livestock, you're going to have a delivery truck that's going to bring feed occasionally. You're going to pay for that. Think of that as your pensions, your Social Security, your guaranteed income. Okay. If I can, if you need, we'll simplify. If you need $100,000 a year and you can get $40,000 a year from the delivery truck. Okay, good. That's awesome. And we don't have enough of that. They don't have pensions anymore. You need to build your own through asset-backed pensions. Okay. Income, Social Security. A lot of people don't trust it. Nobody has pensions. Well, then go out, build your own. Annuities, life insurance, whatever that's going to be to create some income that you can rely on. Because when you have that, guess what? You have less to worry. You have less to worry on your assets. And I'll wrap this up quickly. But the difference is if I now need another $60,000 a year, then I have to put that in the silo. Okay. That's cash equivalents. That's money you can just dip into because if the economy goes down, like you said, you don't want to sell your assets. And that's going to be about 2 to 3 years. And then after that, you got to have a haystack. Think of it as the grain drying out for the silo, mostly income producing, not really looking for growth there. And it trickles down. You keep refilling. And what does that mean? It means about 7+ years out, that's your field. And the field will occasionally get eaten by locusts. It happens. But guess what? You don't want the cattle walking to the field and feeding off of it. And then all of a sudden finding the cattle can't feed because you're trying to sell what's on the field and the locust ate half of it. You've got to let the crops recover. And if you've built this out correctly, you'll get to a point where the crops can get the locusts now and then, but most of the time they will be bountiful and they will provide what you can get and take from in the good years. And it's a balance between having those things. Unfortunately, most people only have the field and they love the field because look at all the bumper crops I'm getting year to year to year to year. Human nature does not have the capacity to understand and think to the future threat, which is why when the locusts come, the world goes into famine. Don't go into famine. Prepare today. Build a solid financial plan.
Awesome. Thanks for the metaphor, Doug. And please don't buy the farm on us. So gotta wrap that one up.
Well, with real estate right now, farming is a different conversation. You know, for another interview and another day.
All right. So, all right. This is a fun episode. I got to say, this has been a lot of fun so far. So, all right. To wrap it up with a good Alice in Wonderland quote. So that's just the trouble with me. I give myself good advice, but I seldom follow it. So, Barb, how would you give, as we wrap it up here, final advice here for our listeners, and what's some advice that they can follow?
I want to take my hat off to Doug. I thought what he said was superb. And with all of our chitter chatter today, there are a couple final premises. We don't know the future. We know the past very well. We don't know what will happen. It may correspond with the past. And frankly, that's the only approximation of a guess to the future that we have. We do need insurance because the stock market periodically tanks. And that's something I'm going to say with a degree of certainty that will happen in the future. And unless you can tolerate a 50% drop in your assets, you do need to be diversified. You need a certain amount of cash for your current and short-term needs. You need some bonds to minimize the volatility of your portfolio. You need a diversified stock market portfolio if you are a long-term investor. Because over the long haul, that type of plan is likely, not guaranteed, but likely to give you enough to live on in the future. It's not a contest to who can make the most money in the next 6 months. It's a contest for you to win so that you take your earnings today, allocate them smartly so that tomorrow and in the future, you have enough money to live in the way that you would prefer throughout your entire life. I am Barbara Friedberg. Watch out for FOMO. Watch out for the latest fads. Go back to the basics. You will not lose if you keep a little bit of cash on the sidelines. I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance.
Thanks for coming on, Barb. And Doug, final thoughts from you.
Yeah, I like the last quote you just said, Kirk, because it reminds me of the other saying is the cobbler's kids always have the worst shoes, or however that quote goes, right? You know, you tend to take care of yourself last. You know, as I mentioned, you know, with the farm and the volatility and the things with the stock market, the other thing that's also important to remember is if you do have all of these pieces and components in place, that in the long run, it actually gives you permission to enjoy the assets you have. Okay. Because if you have all of your wealth in the field, okay, then the field can eventually become a dust bowl. It can eventually go to zero. If you overspend it, it's gone and you'll have nothing left, which means that there will be psychologically a bigger stressor to you in how you use that money once you transition from your earning years to your distribution years in retirement. If you have more things that you've built to diversify incomes and other sources, it actually will take the pressure off that and allow you to enjoy those assets more, because you'll know that at the end of the day, there will always be something coming in. Prepare yourself to be able to prepare to look at that. And mathematically, I'll leave you with this. Einstein had the quote, he's often quoted incorrectly, compounding interest is the eighth wonder of the world. The actual quote is continuously compounding interest is the eighth wonder of the world. Okay. If you interrupt it by selling it, it's not compounding anymore. And that's why it is critically important to understand that the growth you're getting in your investments is not compounding interest. It's an accumulation that can also be given back tomorrow if the wrong factors come together. Okay. So do your planning, get it right. And one of the big things you need to plan for that's going to erode a lot of your wealth is paying for college. Okay. It's a big stressor for everybody. And again, at the end of the day, lack of access to capital, whether you're paying for college or retirement or anything else, is the number one cause of financial stress. So build up the right plans to have the capital you need for those goals. And if you want to figure out how to get your cost for college down and have a plan to get you through college and potentially even come out the other side better prepared for your retirement than you were going in, then you have to have the right information. Learn more at my site, procollegeplanners.com, procollegeplanners.com. Douglas Heagren. Thanks, Kirk.
Great. Thanks, Doug. And just a point of reference for all those who continue to quote Einstein, that he never actually said that. I don't mean to call Doug out, but it's actually, it's one of those things I have an issue with. People quote it all. Somebody came up with it like, 10 years ago, and they made it up. Like, oh, Einstein said that. I actually did a blog post about this, and that's why I bring it up, because it was just funny that all the misquotes out there. But it is an important point, so I don't want to take anything away from Doug, because Doug's a very, very sharp guy. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.